So now before we talk about China, we can do a quick little Fed update. Now that things have come across, they've essentially come out and maintained the course in terms of their dovish stance, which has sent a lot of the riskier assets, which were already, essentially bid through the early hours, essentially higher, which shouldn't be surprising. Based on the commentary we've heard, they've been very adamant about trying to maintain this average of 2% inflation, and they remain accommodative for financial conditions, supporting activity. Which, if you go back to the commentary about, zombie companies and the fact that the Fed is keeping these zombie companies alive, that still holds true here. But, you can't fight the market, you can't fight the price action. So it's just a matter of trying to pick spots and understand, where is their strength, where are the weaknesses, and how do you kind of manage the two. So when we go into other place that has a lot of zombie companies and investments, we can turn to the Chinese investment breakdowns. So here, this is just a good one because it shows the breakdown between state-owned and private. So the problem with state-owned is just, obviously, it's state-owned. So there's a certain amount of provincial backing, PBOC backing, CCP backing. And the question is, where is the support coming from? And you're seeing some of that slow down because the idea is they want to support more private investment and more private enterprise. So you're starting to see a little bit of a shift in terms of how dollars are being pushed through the system, specifically on different bonds. With provinces and local banks being told, not only are you going to cut the interest that you're accepting, you're going to give reprieves to different companies. You also have to increase your lending, which is already tough because they're sitting on stressed balance sheets to begin with. Which is why when we ended the last segment, we talked about China looking to reduce their treasury holdings from 1.1 trillion to about 800 billion. And the question is, well, why? Is it really going to push or hurt the U.S., or is it more along the lines of they need physical dollars to help support their balance sheet and provide that backstop? And if you just look at kind of where yields are going, the idea is that it's more of an inflation fear. It's more of they need this capital, they need these foreign reserves to help essentially them protect their currency, protect their yield. Because the thing is, as yields go up, prices are coming down. So if they're inverse to each other. So typically if prices are coming down, it's because you have a lot of guys selling, a lot of guys want to get out, and yields are going up. So the idea is you want to try to manage this, and you want to try to manage these different factors. And that's where we're starting to look at where the 10-year bond is starting to show a little bit of cracks, showing some issues, which the PBOC is trying to manage because you don't want to let that get out of hand. You don't want that to become a bigger problem while you're trying to stimulate the economy. Because when we look at the net government bond financing, you can see it's all really being driven by a significant amount of just global Chinese stimulus, because the government, the PBOC, the banks are being told and or forced to really continue to drive additional lending and capital into the market, which is why we think that the global cyclicals, defensives, here, when you look at just kind of where that annual change is, you see it continuing to drift to the upside, and it's all being backed by net government bond financing. You continue to see this push higher as we see the special purpose bonds, bonds being issued from a provincial level, from state-owned banks. And even the shadow banking has become a problem, because shadow banking was something that China aggressively went after, tried to cut, tried to protect, tried to bring it more into the state side. And here they're letting some of that shadow banking come back just because they've already seen a huge push through that government backing. And the question is, how much can the government continue to back, continue to stimulate in this closed economy as this pressure continues to mount from the outside, with a fall in exports, or at least weight in exports, the local consumer continuing to struggle within China itself, which again is just putting that additional weight on the market overall. So when we put all of these together and we look at the fixed asset investments, the industrial production, retail sales are now slightly positive year over year, which again was kind of that last thing to kind of pop into the positive territory. But you have to think of what is it on the back of? Is it on the back of stimulus? Is it on the back of a real recovery? And it's going to be a mixture of both. There is a significant amount of stimulus in China, which is helping to support the retail consumer, which is also helping to pull through some of that fixed investment. The problem is the fixed asset investment still remains negative, even though they have pumped in a significant amount of capital. So that's where you're starting to see some of this friction between the cash going in, but then the investments in terms of just where is it going, how is it being pushed through the system, really slowing down. And the industrial production remains relatively fixed at about that 5.6%. And that's where we continue to see that overhang where the industrial production we think is going to kind of drift, let's just say sideways to slightly down as we see additional pressure through the system as we go through the remainder of the year. And when we look at just aggregate financing, it's good to look at it on an aggregating and put it into perspective as we go through the remainder of the previous few years. Because if you remember, China aggressively stimulated at the end of 2016, and we saw that really increase through 17 and 18. And then in 18, they started to slow down a little bit. So 18 was a little bit of a slowdown. 2019, they had some support, but nothing like they had in 2018. And here you get an idea of just how aggressive it started with COVID in February, where you have this huge surge higher and it's just can't stop, won't stop. And it's just because they have to continue to pump this capital in. So when we hear and talk about, oh, well, China's doing so well, they have GDP growth, it's being financed by the government. This is not something that is sustainable. This is something that is going to be a problem overall. The question is always a matter of when, because the statement I just made has been said in 2013, 2014, 2015, 2016. Like everybody's been trying to call the Chinese top. And the question is going to be, when is it happening? And we've been talking about, look, it's not so much a matter of when, it's a matter of how does it start to slow and then roll over. And when we look at food inflation, pork, the issues in terms of trade, in terms of, geopolitical stability, that's where we start to see these issues because this can't last forever. And we think it's something where they're starting to come into an inherent problem, which is why they're looking to pull those dollars forward to help stimulate, to help essentially create a backing so that they can continue to come out and stimulate the economy, trying to get to the other side of COVID. Because the issue for COVID is no longer so much within China, but it's their trade partners. And if you think about the fact that the second largest economy in the world relies so much on exports, you need your trade partners to not only want to trade with you in terms of geopolitics, but also the ability to, just given the fact that they've already experienced their slowdowns and we have another increase in COVID, coming out of Europe. And then the question is going to be what happens going forward as we go into the remainder of the year. And here's where we look at freight. So on a Shanghai level, you see a big increase in container freight. So this is a positive to see. We're seeing additional freight index, continuing to move higher, which is a bit supportive in terms of some of these goods that have been going out, some of these back orders. The question is going to be the overall market within China itself, because China itself continues to struggle on a net level, where Shanghai continues to see a little bit of a benefit. The question is going to be, is that sustainable? Is that something that can continue to work as we go through the remainder of the year? And when we look at India, so, when we talk about China, we also have to kind of look at, all right, well, what is happening in India? Because India is a big part of those Asian exports. And you can see the Indian exports continue to fall, or at least, after that hard bounce start to normalize. So it's a tale of two cities, because where we have China on one side with the Shanghai increase, we have India exports down. We have, South Korean exports down. We have Japanese imports down. Again, off the bottom, but still not positive. So is this China taking market share? Is this a catch-up trade? There's a lot of things that we still don't really know how sustainable some of this Chinese moves are, especially given the fact that it's being driven so much by just new debt, Chinese lending, Chinese government lending, that it's just a matter of what is real and what is fake, which is, I guess, really always been the problem when we look at China. And really wrapping up and looking at China retail sales on a little bit of a deeper dive, you can see that the retail China retail sales based on the value year over year, we're back to about that 0.5. So we're back to the growth level in terms of total value. But when we look at cumulative sales, you can see that we're still down 8.6%. And it's still good. It's still a positive. We still moved we're still moving in the right direction. It's just the pace of moves is slowing, which is putting the overall pressure on just China itself. Because when you look at how is GDP calculated, what are we looking at? The import levels are still telling a story where imports are still down or at least flat. And that means that the consumer is struggling, where retail sales, sales in general are down because the consumer isn't buying, but also they're importing less raw materials, which means exports are going to slow, which is why that Shanghai index is something to watch. And these are pressures that are going to continue, which we're always going to look at to understand what comes next. So coming up, we have our another show in terms of China-India updates, what's happening on that standoff, and then food inflation. And then obviously we wrap up with our favorite segment, the Primary Vision Frac Spread Count. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.